Okay, let's unpack this newsletter. You know that feeling when something seems kind of magnificent, but then it just takes a dark turn? Like,
Mm-hmm.
remember Magnificent turning into Maleficent? That's sort of the vibe the macro butler is getting from global trade right now.
Yeah, it's a clever hook, and their latest Maleficent trade wars and the art of global chaos really sets a dramatic tone.
Totally. And look, your mission today, listening in, is to get the key takeaways from this with us quickly, without getting bogged down in jargon, a shortcut to understanding these big shifts.
Right, because this stuff, these trade dynamics, they eventually trickle down, don't they?
Yeah.
Affecting investments, maybe even groceries.
Exactly. So the newsletter kicks off this Maleficent idea talking about April 2nd, U.S. Liberation Day, they call it, kind of
Right.
ironically.
Liberation Day sounds grand, but liberation from what exactly?
Well, that's the thing. The newsletter quickly points to some major policy U-turns on trade that happened right after, so maybe not so straightforward.
Some more uncertainty layered on top.
You got it. And the big move. New tariffs from the 47th president back since, what, January 20th, 2025?
Right.
We're talking a flat 10% tax on pretty much all imports. And then for China, a huge 145% tariff.
Wow. And that's on top of the tariffs already in place.
Yep, stacked right on top.
So the newsletter's calculation, American companies, consumers, they're paying an extra 25% in tariff taxes. Just like that.
In just 3 months, yeah. It's a massive hike.
No kidding. And what are the economists saying? The forecast in the newsletter.
It's not pretty. They're talking maybe a 1% GDP shrink this year, 2025, and prices up maybe 1.6% to 2.7%.
Oof. Sounds like stagflation whispers.
Doesn't it? Like
Yeah.
the 70s calling. But the newsletter says the biggest headache isn't just the numbers, it's the whiplash-inducing uncertainty.
Right. Because trade rules are changing by executive order, maybe even tweets. Businesses hate that.
Totally. They just pause, hold off on big investments, like trying to plan a trip when the roads keep disappearing.
And there's data on this feeling, right? The U.S. Economic Policy Uncertainty Trade Index.
Yeah, the newsletter flags it. Says it's hitting record highs.
Higher even than during the tariff tantrum back in 2018, 2019.
That's what it says, which really says something about the level of instability now.
Okay, so the newsletter also brings up this market indicator, the S&P 500 to oil ratio. How does that fit in?
Right. So it's basically looking at the stock market's value compared to oil prices against its own history, like a 7-year average. It's seen as a signal of economic health.
And the connection to trade uncertainty is?
Historically, when trade policy gets this messy, this uncertain, the S&P 500 tends to kind of lag behind oil prices. That ratio drops below its average.
And that drop often signals
Not what?
what? An economic slowdown coming.
Yeah, that's the historical pattern the newsletter points to, like a warning light flashing on the dashboard.
Makes sense. And this uncertainty, it doesn't just affect market ratios, it hits company earnings forecasts too.
Directly, the newsletter connects a jump in that uncertainty index to a likely drop in expected S&P 500 earnings about 6 to 9 months later.
Because businesses just aren't investing when things are this chaotic.
Exactly. Okay, shifting gears a bit. Geopolitics. That huge tariff on China, the effective rate is like 135%. It's being framed as national security, right?
Yeah, that's the official line. But the newsletter points out talks with China are basically stalled, deadlocked.
And China's just taking it.
Not exactly. They're retaliating, sure, but they also seem focused on boosting their own internal demand. They can absorb some of the pressure, it seems.
While the U.S. strategy of rallying allies to isolate China maybe isn't working out as planned.
That seems to be the implication. And this whole back and forth since 2018, the newsletter uses a pretty vivid analogy.
Oh, yeah. What's that?
Less Adam Smith, more WWE.
Huh. Okay, so less about economics, more about flexing muscles, maybe shaking up the global system.
That's the suggestion, dismantling a system that maybe limits American unilateral action.
But here's a twist. U.S. imports from China are down. Okay. But China's exports to other Asian countries, like Asian nations, they're up.
Right. That's a fascinating, kind of ironic point in the newsletter.
Hmm.
The U.S. trade war might actually be strengthening regional trade in Asia, unintentionally.
While China keeps doing its thing, decoupling from the West, rerouting goods through places like Vietnam, expanding the Belt and Road.
Exactly.
Yeah.
Which leads back to the idea that these U.S. tariffs, they're probably just going to mean higher prices for American consumers, that boomerang effect.
Right back to our wallets.
And the newsletter connects the dots further, linking these trade tensions to other hotspots, like renewed friction with Iran over nuclear stuff.
Oh, great. So, risk of military action, potential oil price spikes on top of everything else.
Another layer of risk for the
Amazing.
global economy, yeah.
Hmm?
Iran's still exporting a lot of oil, mostly to Asia, especially China.
Yeah.
Any disruption there?
Could make things much worse. Gas prices, inflation, the works.
And interestingly, the newsletter suggests there isn't much political will, either in the U.S. or China, for a big compromise right now.
Leading to, what do they call it, economic whack-a-mole?
Yeah, companies just constantly try to dodge the latest tariff.
You see that with the exemptions, though, right? Like smartphones, computer hardware.
Yeah.
They're going to pass on the really high tariffs.
Which does suggest political calculations are playing a big role, maybe more than pure economics.
But the newsletter warns about the hidden impact, doesn't it? The tariffs on components, the stuff inside, the things we buy.
Absolutely. That's a huge issue for U.S. manufacturing construction, too.
Mm.
Shortages, price hikes, stuff people might not immediately link back to tariffs.
So your Netflix is fine, but maybe building that deck gets way more expensive. Tariff-induced stagflation, home improvement edition.
Pretty much. And the irony, the newsletter points out, is that even industries the tariffs are meant to help, like textiles or autos, they rely heavily on Chinese parts.
So they get hit too. It's paradoxical.
And the data apparently shows the U.S. is way more dependent on Chinese manufacturing inputs than China is on U.S. inputs.
Which means China's counter tariffs might hurt us more. Where would they hit hardest?
Primarily high-tech sectors, the newsletter suggests. Semiconductors, aerospace, areas where the U.S. is a key supplier.
Man, it's almost darkly funny. The policies might end up hurting those MAGA hat-wearing workers in cars and construction, the very people they were supposedly aimed at helping.
And this whole situation leads the newsletter to talk about platform companies. You know, the giants built on free trade, tech progress, easy logistics.
The big tech types, the Magnificent Seven.
Exactly. Their whole model, invent here, make there, sell everywhere, pay low taxes, that model is getting seriously undermined by all this.
Their anti-fragile reputation. Maybe not so anti-fragile anymore, especially with governments needing cash and looking at tariffs.
The newsletter argues their model is cracking. Tariffs are one way governments try to claw back revenue, hitting these companies' profits.
And if they can't just pass the cost on to consumers, margins get squeezed. That Magnificent Seven valuation might not hold up.
Which is where the Maleficent 7 idea comes in. If they face higher taxes, stagflation headwinds. We could see a big valuation reset for big tech.
While maybe older economy sectors, like U.S. energy, could make a comeback, especially if that S&P to oil ratio keeps falling.
That's a possibility floated in the newsletter. It's all connected, too. Think about U.S. debt.
Okay.
China, Japan, big holders of treasuries. Their economies are slowing, there are tensions, they're selling U.S. debt.
Which pushes up our long-term interest rates.
Exactly. And this undermines the idea that the trade war brings back manufacturing jobs. The newsletter is pretty blunt. It's more likely to bring stagflation, like the 70s.
Because companies left for more than just cheap labor, right? Regulations, taxes.
Big factors, yeah. So the outcome probably isn't more U.S. factories, but slower growth, higher prices, and the strategic goals aren't met.
It's the Maleficent trap again. Set for one target, but catching others, too.
And the newsletter throws in a little reality check mentioning humanoid robots at the Canton Trade Fair 2025. A reminder not to underestimate China's progress.
Right. Don't misjudge your enemy, as some say might say. Okay, so for investors, for us trying to navigate this, what's the advice?
Adapt. Focus shifts. It's less about chasing maximum return on capital, more about ensuring the return of capital.
Preservation becomes key. How? What does the newsletter suggest?
Real assets. Physical gold and silver are highlighted as truly anti-fragile, no counterparty risk. Other commodities, too, for inflation protection.
And cash.
Active management. Short-term, high-quality stuff. Investment-grade USD bonds, T-bills.
And stocks.
Favor companies with strong balance sheets, low debt, good earnings, solid free cash flow. And maybe lean towards energy and commodity producers over consumer-focused companies.
Yeah.
So the takeaways are trade wars rebranded as deals, Trump-imperialism, tariffs and tweets signaling stagflation, the real risk of Trump stagflation, tariffs hurting many U.S. sectors, the Magnificent Seven looking vulnerable, energy potentially bouncing back, capital preservation being crucial, and gold-silver looking attractive.
And right now, April 25th, 2025, we're in this weird spot. An inflationary boom, but maybe heading for a bust.
Yeah, the indicators are flashing yellow, maybe red. The advice is stay calm, disciplined, watch the data closely.
The newsletter also paints this picture of the world kind of splitting into zones, right? Southeast Asia, Fortress America, Europe.
Exactly. With the U.S. pulling back from its global security role, Asian nations are maybe looking more towards China, who's trying to build its own regional financial system.
But investors are still piled into big tech, those Maleficent 7.
Portfolios are still overweight, yeah. The advice is maybe trim exposure there, and also look carefully at companies with super low tax rates, which might become targets. Real estate, utilities too, surprisingly low rates sometimes.
And if the dollar loses its reserve status dominance, what happens then?
Could fall against Asian currencies. U.S. interest rates could rise further. Domestically, a weak economy isn't usually good news for the incumbent administration.
And Europe, companies relying on Europe.
Could be a tough road ahead for them, according to the analysis.
And through it all, there's gold. Timeless, anti-fragile. It's price tracking that trade uncertainty index.
Right, and owning it physically, outside the digital system, offers a kind of autonomy. Protection against currency issues, but also against increasing financial centralization.
So wrapping up this deep dive into Maleficent trade wars. It's complex, messy, and definitely carries risks. Feels like we've gone from Goldilocks to maybe golden lots, huh?
Yeah, focusing on those real assets, it definitely leaves you thinking.
It does. How might these huge shifts affect you personally? What other questions pop up? Hopefully this chat gave you a good shortcut through the chaos.